you are seeing this proprietary data from Amarok, which will not be available in the marketplace. So let me quickly go through this presentation. Every morning that you pick up the newspapers, there is positive reports that are coming up in the Indian real estate, whether it's residential, offices, retail, warehousing, private equity. So across the board, there are great news that are coming up. Also on the fundraise side, if you were to look at it, the QIPs that were done in calendar year 2024, real estate has been the highest in terms of raising funds through QIP. Nearly $2.6 billion of the overall QIP pie was taken up by real estate. So you're seeing real estate really on top of chart with 16% of the QIPs getting into the real estate. Let me now get into how the market is doing both on the Nifty and the BSE Sensex versus on the reality side. If you look at it, whilst Nifty grew over the 7-year period by 125%, the reality index has grown over 200% in both the S&P BSE index, reality index, as well as the Nifty reality index. So on that perspective, the real estate continues to do very well as far as the indices are concerned and the listed players are concerned. I'm now going to get into the three major segments of Indian real estate. These are the physical assets. Till now, what I was saying was more on the listed space. I'm going to get more into the physical because this is what most of the NRIs would love to know. How are the markets really doing on the ground? So here you go on the office side. Busy slide. I'll give you a little bit of time to digest it. But what it says is on the green side, we earmark the amount of grade A offices that were completed for that year. And we've been tracking it since 2010. And in the orange one, you see net absorption. Net absorption is nothing other than net leasing, not gross leasing. So gross leasing can be much greater than this. Then there may be some players who've given up space, and the net is what one should really look at it. So if you see 50 million square feet of offices were leased in calendar year 2024, 50 million square feet, that's nearly 5 crore square feet. Never ever in the history of independent India have we seen this kind of leasing activity. The previous, if you look at it, was just before COVID, that was about 40 million square feet. So we've had a bumper year in 2024 on the leasing side. Those of you have interest on the gross leasing, this year that had come up to about 80 million square feet of gross leasing. Net leasing was about 50 million. If you were to speak with someone from the US or maybe even Europe, offices is a bad word. People are like, I don't want to build offices. And here we're saying is, guys, we're running out of sort of space for offices in grade A buildings. As we go on, you'll see through this is why offices are doing well is because of the global capability centers. These are corporates coming in largely from the US who are setting up their base in India. So nearly 1,800 new GCCs set up a base in India in 2024. Our estimate through the various sources is that this will go up to nearly 3,000. I mean, this is like amazing amount of GCCs coming into India. Why they're coming in? Because the salary of engineers is much lower. Second, more importantly, there are a lot of STEM graduates available in India than in many of the other Western world. So, for example, if a corporate is GCC is coming into India and they want 1,000 software engineers to be recruited in a month's time, it is possible to do it in India. This is not possible to do it in the US. Even despite higher salaries, they would just not be able to find that kind of a talent. That's what's driving them to India, GCCs to come into India. This is a proprietary slide. It's an interesting slide. What it says is that in the green is the grade A space in that particular city. In purple is the vacancy, and in the orange is the planned and under construction that is getting built up. So if you were to look at it, Pune, Bangalore, they both are really at the optimum. 10% will always remain as a structural vacancy in the markets. And for us, at 10%, that means this is really running at 150 miles an hour, and it's the optimal capacity at which the office leasing are going on. Hyderabad is the only market that I'm a little bit scared that it has got too much of supply that is coming up. Nearly 37 million square feet of new supply. Hyderabad leases about 10 million square feet a year. So there's 4 million square feet of new supply that is under construction at this moment in time in Hyderabad. Other than Hyderabad, I'm sort of reasonably okay with the other cities. Although someone may say that Bombay also has nearly 16% of vacancy, but I mean that gets absorbed very quickly at 20 million square feet of the total new supply that is coming up. Hyderabad, to me, with 37 million and about 10 million annual take up is a lot more that will need to be picked up from the office leasing perspective. A lot of people think that offices are being only leased by the IT companies, and I thought this chart is important to put it up. That the purple, which is where the IT and ITES are represented, but if you were to look at overall, it is a very healthy mixture. IT ITES is about 18-20%, followed by the banking, financial services, consulting, manufacturing, e-commerce. What is interesting is that co-working guys are taking up very large spaces within these office parks. So it is not only dependent on just IT, ITS, which many years ago used to be highly dependent on that. But today, if you were to look at it, it's a very eclectic mix of the occupier profile who's taking up offices. These are the REITs. If you were to look at it, clearly the REITs have done well from where they were last year to this year. Embassy REIT, Mindspace, and Brookfield have grown in terms of capital appreciation. This capital appreciation is in addition to the dividend income that they would have given during the year. I'll move on to the retail part of it. So in terms of the physical retail, the way that you saw offices is similar. The net absorption has been very good this year, nearly 6 million square feet of net absorption. What has been challenging is that the supply hasn't come in of the new grade A malls. If you look at it, there's just been 1 million square feet of new supply that has come up on retail. There is a fair amount of demand. This is the demand coming in from. Apparel is nearly 37%. What has increased post-COVID is entertainment and F&B. That has increased. If you were to look at it before COVID, that was about 20% of the mall spaces. That has now moved to about 30% of the mall spaces. Largely driven by the Indian occupiers, domestic occupiers, unlike in the office where it is largely driven by the US corporates. in retail, it's majority 77% really is from the domestic, and then followed by EMEA, America, and the rest of APAC. One of the things that we hear often is that there is a huge amount of vacancy in malls. And what I requested our research team was if they could divide the vacancy levels in grade A, B, and C malls. And that is what they have done is. So actually, they have distilled the noise that we hear that there is a lot of vacancy in the malls. In tier A malls, grade A malls, if you were to look at it, it's a low single digit vacancy. So if you were to look at NCR or Calcutta or any of these Chennai, look at it, it's 1-2% vacancy. Even otherwise, Pune, Bombay, Bangalore, low single digit vacancy. Where it averages out is because of the grade C vacancy that you see double digit overall news that comes out vacancy in malls. But if you peel the onion, you will see is that grade A malls have very low vacancy and it's a good asset class to invest in. The only REIT that we have, there are 4 REITs in India. As the investors, you can buy in any of these 4 REITs. The first 3 are office REITs, Embassy, Mindspace, and Brookfield. And the fourth is the retail REIT. It is led by Blackstone, and it is called as the Nexus Select Trust REIT. Over the course of 1.5 years, it has done pretty well. Got listed at 104. Is somewhere trading at 135 to 140 rupees now, in addition to the dividend income that they have got. Whatever we have discussed till now is only 20% of the Indian real estate. 80% of the Indian real estate is this sector, which is the residential sector. And Anand, you had mentioned is that how has the market evolved? So this is the slide that talks about the market. It used to be an absolute fearless market, completely unregulated, led by investors. Majority of this activity was happening in the NCR, and that was the period sort of 2013 and earlier to that. Fearless. It didn't matter, Anand, that as a home buyer, you would give me money and buy an apartment from me as a developer, and I could do whatever I wanted to do with that money, whether I went out and bought a new Ferrari or a new aeroplane, or went on holidays with that money, or I bought a new parcel of land. Nobody could say anything to me, and that is what I mentioned it as. It was like absolutely fearless. It didn't matter. Then came in the regulation, the Real Estate Regulation Act, demonetization, GST, then all the ILFS collapse, that happened as a result of which huge amount of liquidity problem. So that is what we are calling it as the regulated era from 2015, 16, 17, and look at the drop that happened in the supply. Because suddenly Real Estate Regulation Act came in, and that act said is that Mr. Developer, if you are selling, then you have to complete it within the stipulated period of time. And if you're not able to complete it, then there is going to be penal circumstances towards that. Not only that whatever the installment that you're receiving from the home buyer, 70% of this will be going into an escrow that will be utilized only for construction. So that answers another question, Anand, from the perspective of the NRIs, that today the Real Estate Regulation Act has made the developers institutional, because when you buy apartments under construction under RERA, 70% of the installment that you are giving goes necessarily into a escrow account to be utilized for construction activity. 30% is what the developer can take it out. And by the way, that's absolutely fine. They can take out 30% because that, in a way, is the value of the land that they're bringing onto the table. So as a result of it, they're taking 30% equivalent to the value of the land to buy another piece of land and utilize the 70% of the money. So even if the developer was to go bankrupt, then you know that 70% of your money is in the escrow. So new developer can easily come in into the shoes of the old developer and complete the development, given that there is enough money in the bank account. From 2018 onwards, the market sort of started, and then we had COVID. This is what it is, 2020, which was the lowest that we saw. Since then, the market has been at its high. I mean, if you look at it from 21, 22, 23, 24, absolutely renewed growth that has come in. But I must also say is that it is not being led by speculators, investors. It's a very consolidated market today, largely led by the listed players. 2023 was the best year ever that we have had in terms of the number of units sold. 2024, for the viewers, it was 2% less than 2023. So after nearly 3 years of or 4 years of hectic growth from 2020 to 21 to 22 to 23, 24 has had a slackness of 2% in terms of the drop in number of units sold. But in terms of the total value, it has gone up by 19% from 23 in terms of the sales. The reason for that is that the prices have gone up, as a result of which the total sales value in 24 is 19% more than the sales value of 2023. This is an interesting slide. Again, it's proprietary. We don't show what it says here is that how is the sales activity in value terms across these top 7 cities. So actually, MMR is a defining territory for the Indian residential market. Nearly 41% of the overall sales in 2024 came in from MMR. I remember way back in 2000, sort of 10, 11, 12, this used to be the case for NCR. Nearly 40-50% of the overall sales used to come from NCR. Today, this amount is coming in from MMR. If you combine Pune into this, this crosses sort of 50%. So Maharashtra will contribute nearly 50% of the top 7 cities' resi sales. The second question many people ask us is, then what's the total value of new homes sold? So in these 7 cities, it's about $67 billion of new homes that were sold in 2024. MMR being number 1, followed by NCR. Or close on the heels of NCR is Bangalore, then Pune, then Hyderabad. Really, Chennai and Calcutta way down below. I mean, Calcutta certainly is way below, nearly $1.3 billion in comparison to Mumbai of $27.7 million. It's a sad slide, I must say. Why I say sad slide? Because it is showing that the affordable housing is going down. From 2018, when it used to contribute 40% of the overall sales in the market, it has now gone down to nearly 16%. What is interesting is, if you look at it, luxury and ultra luxury has really taken up the benchmark. Nearly 31% of the sales is from luxury and ultra luxury. In 2018, this number used to be 9%. And that's where, a city like Bombay MMR is really flourishing, because majority of this luxury, ultra luxury sale is in the MMR region, followed by NCR, and to a lesser extent, it is Bombay. I'm going to, Anand, Shanto, if it's okay with you, take all these questions a little later. maybe towards the end of this
No,
presentation.
absolutely.
Otherwise, I may just break the flow of the presentation.
No,
Sure,
absolutely.
Anuj.
Super. So, one of the things that, a lot of the investors who meet up with me ask is that, Anuj, has this market become unaffordable for the home buyer because the property prices have continued to go up over the last 3 or 4 years? And I asked our, research team to put this together slide on the affordability and, look at it. What they have done is that this is the affordability ratio that they have is, which is the sort of home loan payment divided by the income in number of months. So the higher the number of months, the lower the affordability. The lower the number of months, the higher the affordability. So, for example, in 2008 or 2007, it used to be like 56, 58 months of income required to buy a home. Today that has come down to 38, which is still better than where we were in the past. Certainly, it has gone up from the COVID times when it was 27 months, 28 months. It's gone up to 38 months. But the point that I want to make is that it is still affordable, because it is not that the property prices have gone ahead faster than the income levels. So over a period of time, if you were to look at it, over a period of, I would say, 10 years, the income levels have risen faster than the property prices. In those 10 years, for the first 6 years, from 2014 to 2020, every year, the income levels were far ahead of the increase in property prices. In the 4 years, from 2020 to 2024, the property prices have overtaken the income levels. But on an overall 10-year period, the property prices, still the increase in the property prices is lower than the increase in the income levels. This is the unsold inventory in number of months. So at the end of 2024, it's 14 months of unsold inventory. By the way, 18 months is where the equilibrium is. This unsold inventory is not inventory that is completed and unsold. This is inventory which is under construction and unsold. So that's why I'm saying is, you should take 18 months as an equilibrium. So actually the market is in favor of the developer, because if it is lower than 18 months, it becomes in favor of the developer. That means that the demand is far greater than the supply. If it goes above 18 months, then it goes in favor of the home buyer, which means the supply is greater than the demand. One of the things that I said is, let's see how the listed players have given guidance for their FY25 sale in comparison to FY24 sales. So clearly you can see is that majority of the developers are very enthusiastic in FY25. I do feel many of them will even be able to breach the guidance that they have given to the market. Someone like Prestige, 26,000 crores guidance that they've given. Godrej has given 27,000 crores. I mean, I still remember is before COVID hit, none of them were even getting up to 10,000 crores. So you can well imagine is that all these players were at 7, 8, 8.5, 9,000 crores. Not only they have breached the 10,000, they're now breaching the 20,000 and moving towards 30,000 crores. I'll just quickly cover two more segments. One is the private equity investments that have come into India. In the first half of the financial year 2024, we haven't yet compiled for the Q3. This is Q1 and Q2. Again, in the H1, of FY25, we saw that compared to the full year of 2024, there were 62% of private equity that had come in. Seems like FY25 will also be a decent year with the private equity. Where have they invested? On the right hand side, you'll see is that they've largely, coming into the sort of industrial logistics, office, that sort of a thing that they are coming in. Very little on the residential. Private equity is still not comfortable investing into residential for sale. They are okay to do residential for lease, but then the rental incomes are so low that the yields don't stack up. As a result of which, they're not playing in the residential, which is the purple band that you see. Private equity is very happy on the commercial income yielding asset, or very happy on the industrial logistics, again income yielding. Majority of the money that you're seeing that is going in the investment is coming in from foreign funds on the private equity side. So domestic are still a very small proportion. Both you saw that in FY24, even before FY24. It's the Blackstone, Brookfield, GIC, Abu Dhabi Investment Authority, Canadian pension funds, who are the guys who are investing into the Indian physical asset of real estate, not as much the domestic funds. Very quickly, one slide on the warehousing. This is a sector that one should start to track. It has become a very mature sector if you look at it in terms of the growth, in terms of the square footage that is now available as grade A stock, nearly 375 million square feet of grade A stock. These are the typology of players who are taking up the warehousing spaces. And this is becoming from unregulated, fragmented, asset class to a very organized asset class. And what is interesting is that if you take the top 5 players in the warehousing, all 5 players are private equity players. So whether it's Indospace supported by GAC and CPPIB, whether it is ESR, whether it is Blackstone themselves, who are in this space, Logos, and then likewise Wellspun. They're a very, very private equity dominated, and hence they do really beautiful assets, grade A quality of assets. And the last one is data centers. This is also something that you should keep it on your radar. This market is growing leaps and bounds. It's a new asset class that really only came in COVID. It was sort of born in COVID. And the amount of investment that is going on at this point in time from the private equity players in data center is unprecedented. And we're seeing very large players entering the data centers in India. And these are players largely coming in from the US and who are building data centers for lease to third party.